It's up around 1.2% for the Japanese markets, but all other Asian markets are shut on account of the Lunar New Year holiday.
It was the oil to chemicals business which saw very strong growth in this quarter.
ICICI Bank, the net interest margin is perhaps at an all-time high of 4.65%.
On the total APE, a few things that have worked well. On the retail APE, we have grown faster than this sector.
A good opening for the market. The first stake is about 80 points higher.
Our expectation for the Nifty earnings for FY23 are at 11%.
We wanted to make sure that the fundamental ability of Indian domestic shareholders to participate in the wealth creation story of India, we can facilitate.
As far as the future is concerned, the way we are looking at it is the realizations have improved.
18,150 on the Nifty.
Our Q4, we will have 200 to 250 basis points improvement in terms of our EBIT margin.
It's a strong set of numbers coming in from Canara Bank, especially on the NII growth. The NII growth on a sequential basis is about 15.7%.
It's a two-month low for the dollar, a two-month high for the rupee. The reasons are not far to seek. One, of course, the dollar is weakening globally against most currencies.
We continue to be in the green. Good gains. The Nifty has come off from the highs.
Well, that was the day so far. Hello and welcome to Closing Bell, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima. Surabhi is joining us as well. The prodigal closing bell anchor is...
Son returns, daughter returns.
Daughter returns.
I don't want to say daughter. And of course, Nigel is our man in the newsroom. Guys, hi, afternoon. It's a full house, as they say in Hindi, right? Do se bhale teen, teen se bhale char. So, I mean...
It's happy company, I must say, and all smiles and great. I'm missing Nigel in the studio, but it's okay. We're all connected, and that's the important thing.
We'll figure that.
You'll figure that.
All right, let's just quickly kickstart this with a brief comment on the market. So it's a strong day, absolutely no doubt about it. We've got the Nifty, which is not at the high point of the day, but it's been strong from the word go. Broader market is a bit more tepid. I mean, you look at the small cap index, which is actually, it's a red bar. The mid cap index is doing a little better. Market breadth as a consequence is a little negative. The day's high so far on the Nifty is 18,162. On the upside, and this is the level we put out in the morning as well, you need to get to about 18,184 and beyond. I mean, that's a retracement and a recent swing high. So that's the level you need to take out. First, of course, back to the day high and then another 20, 30 points. IT is doing well. Auto, pharma and PSU banks are the 3 or 4 sectors which are doing the best. And I think after the powerful move in the US, a follow-through tonight in the US perhaps will add to the confidence. Guys, hi.
Hi, so the intraday high today was 18,162, and once again in the last 30 minutes, markets are trying to make a dash towards that level, and that's the important congestion zone which we faced last week. So pull up the intraday high on the Nifty over the past 3 trading sessions, and you would see that over the last 3 days, the Nifty has faced resistance around 18,150 to 18,184. That intraday high levels will also come up for you on your screen. We used to go to that level and retrace. So that's the first hurdle for our markets to conquer. After that, it will be the 50-day moving average, which is 18,283. Just pull up the intraday chart on the Nifty Bank, and you would see that the Nifty Bank has come off from the day's high. And even though in the last 30 minutes, things have picked up on the market, it's not on the Nifty Bank. And ICICI Bank, despite what, 6th, 7th consecutive quarter of a beat, ICICI Bank is now currently in the red. It's purely IT which is doing well. Even something like L&T, Infotech, Mindtree, LTI, Mindtree, where the earnings missed. LTI, Mindtree is now up close to about 2.5%. But there is so much, right? Expiry, earnings, and then next week we've got the budget.
Oh, absolutely. And, Rima, it takes me back to the conversation we were having on Trading Hour. I mean, IT buying's coming back globally, and I think that the trickle-down effect is so visible on Indian screens as well today. And the other aspect that I was looking at is the way the market seems to be in a ye dil mange more sort of a mood. And the earnings are a case in point. Whether you're looking at Reliance, where despite a blowout quarter, of course, the concern on the kind of leverage that's perhaps going to play out over the next couple of quarters, the capex, and Ultratech Cement. Nigel's been telling us that it's just the fact that you need more price hikes. The market needs more price hikes, and that's not happening immediately. And the pressure is very visible on some of those stocks. So it seems that there is a fair amount of caution out there. Good earnings, maybe not enough. The market's looking for something great. Nigel?
Well, that's right. The put writing is back today. I'm looking at a couple of strikes, the 18,000, 18,100 put, both of them are fairly active in today's trading session. So in an uptrending market, we have had intraday dips, but those dips have got bought into. And it gives the bulls a fighting chance, to go ahead. If you get a strong handover overnight, maybe in fact you're giving yourself a bit of a chance to go past that 18,250 to 18,300. But let's see how that goes. But let's run our viewers through what we have on the show.
Indeed, we've got a whole host of stocks that are reacting to their quarterly numbers. Ultratech skids despite good volume growth as realizations fail to perk up, while JSW Steel, Reliance slipped despite strong earnings.
LTI Mindtree recovers 6% from lows, up around 2.5% despite weak results.
In key earnings to track, we get you the expectations from Axis Bank and Maruti.
And we'll talk all things market and stocks with Sandeep J. Shah of Motilal Oswal Private Wealth Management.
Okay, just under that three-digit mark. I mean, 98, 99 points, 18,124. Mitesh is with us to tell us how you should position yourself, what you should do in terms of the index and stocks. Reasonably strong day, I mean, Mitesh, at least on the Nifty, right? Broader markets perhaps leaves more to be desired, but what would you do?
Good afternoon, Prashant. A couple of things. One, you were highlighting that 18,183 level, which was also the high of Wednesday. And that's the level where, a couple of moving averages are also placed. So I think the continuation signal of this pullback will happen once we start getting past that level. And while it's a good day, it's a strong day. The candlestick today is a doji, I think, which means that we have had a high at levels of around 18,162, a low at about 18,060, and we are somewhere in the middle, which is where we had opened. So it's still slightly mildly undecisive, but I think that could be the case before a breakout. So 18,180, 18,185 is the level to watch out for. Once we start getting past that, I think that should put us into much more comfortable and a smoother up move rather than the choppy up moves which we have been getting for last few days. Having said that, I have a buy on Tech Mahindra. The IT space looks still good, and Tech Mahindra has been doing well since the last few days. So now it's a buy with a stop at 1,055 for targets of 1,090. And okay. UPL is a buy as well. Keep a stop below levels of 740 for targets around 770.
Got it. All right, Mitesh, thanks a lot for giving us that call. Well, let's run you through the space that is under some pressure, and then we'll go across to Gurmeet Chadda to get his view on the cement stocks. Ultratech Cement, the numbers were in line. The problem is that realizations were soft, and the management outlook as well on realizations front wasn't very, very good. So that's why the stock is under pressure. And you have a couple of other names as well from the cement pack that are seeing some bit of seller. Let's run you through the management commentary then. They believe that cement prices will stay stable. They're not giving any concrete guidance in terms of price hikes to come about. The street, remember, would be working with price increases for FY24 in their EPS estimates as well as the EBITDA estimates. And the focus the Ultratech Cement management indicated was more on operating leverage as well as rather than price hikes. Now, demand, they say it's rock solid, and getting into election year, they are seeing no worries on that front. The blended cost, of fuel, they say the current prices are in that vicinity of around $175 per ton. Remember, for the past couple of quarters, that's Q2 and Q3, it's been around $200 per ton. So around $25 per ton softening could translate to around 150 rupees per ton of EBITDA saving. The overall cross trend, though, they're expecting it to remain elevated, particularly, for fly ash as well as for fuel, because China has reopened. There's no fresh petcoke capacity that's coming on stream. And point number 3 is the ongoing, Russia-Ukraine war will keep fuel prices elevated. That's the management guidance. Capex, more or less on expected lines, 6 to around 7,000 crores. The numbers were bang in line, and the beat came on the volumes front. The realizations were up by only around 0.5%. That compares to the expectation that it goes up by around 2%. Gurmeet Chadda of Complete Circle joins us. Gurmeet, well, Ultratech Cement, at the face of it, the numbers were fairly good, or they were bang in line. You can't say that these numbers were a miss at all. However, the realizations increasing by only around 0.5%, when demand is so strong, that's making the street a little bit nervous. The demand's strong, you're pushing through volumes, but what about pricing? Has the cement industry lost that pricing power? Your take on it. How do you approach the sector?
So Nigel, apparently you said it right. There was 12% volume growth, which means they've gained market share because industry volume growth was around 10%. They continue to work at 83% capacity, which means even the operating leverage is likely to play out well, is playing out well. I think what's happened is in the mix. So if you see the volume growth, the mix of premium was just about 18-19%. Also within grey cement, the non-trade and trade. Trade is what your channel sales, and non-trade is where you do institutional sales. Typically, when you supply to institutional sales, the prices are lower, which eventually led to lower EBITDA. So I think it was the mix actually, and the point you made on the cost. So my sense is over maybe next few quarters, the cost should sequentially come down. That should aid realizations, and maybe they can come back to that 1200, 1100, which is where you see a sizable jump in earnings. And the stock trades at considerable premium. You are like a 14, 15 times on your enterprise value. The scope for any disappointment in an environment where interest rate is up is quite less, and that's why you see the the reaction on the street. But in general, I think the first 6 months in the new year are typically good for cement sector. And the second half is when you have the monsoon and the winters, which are relatively weak. So overall constructive, but I think at this valuations, upside gets capped if the performance is average.
The street is truly betting on IT, and perhaps the worst is over. Look at the way the Nifty IT is reacting today. 1.7% up on the index for the year so far. It's a 5% up move. And even where there have been earnings misses like LTI Mindtree, top-down miss, revenues and margins lower than expectations, but the stock is now up 2.5%. So from the day's low, it's recovered close to about 6%. A couple of things that the company told us which may have fueled this optimism that maybe things are going to improve from here on. One, the management told us that in Q4, in the next quarter, we are going to see a 200 to 250 basis points margin improvement. Two, they also indicated that revenue growth in Q4 will be better than the revenue growth in Q3 based on the deal pipeline, the momentum, the deals that they've closed in the quarter gone by. And the third point is their 4 to 5 year vision in terms of the merger synergies. The company is targeting $1 billion of revenue synergies in the next 4 to 5 years and cost synergies to the tune of 200 basis points, which will play out over the next 4 years. So these are three factors which perhaps gives you an indication that Q3 has been bad. It's been hit by integration-related costs and furloughs, lower seasonal days, working days, but things are going to improve. And that's the, feeling that you have across the rest of the IT pack as well. So Emphasis had only 1 day of a decline post its Q3 numbers, and the miss on Friday it was down. Today it's up. L&T Tech as well. It hardly declined on Friday, and today as well you are seeing buying interest come through. Gurmeet,
Rima,
go ahead.
Add to that, Mastech and Wipro. An IT analyst was pointing out, this is just his conjecture, that maybe IT companies have stopped reacting very negatively to bad results.
Yeah.
So, the price is right, and if that is true, it's too early, I think, to kind of make a conclusion like that. But it's interesting that they're not sort of incrementally selling off in a very hard way, because it's a sector which is lost.
But I guess that's also telling you something about the mood of the market as well. IT having gone through what it's gone through in 2022, perhaps the market's willing to look ahead. And like you're saying, if on the horizon, once these issues of integration are behind, for a stock like LTI Mindtree, perhaps, buying always happens ahead of the event, right?
Well, anyway,
buying or selling for that matter.
Nasdaq was up 2.5% on Friday. For the year so far, it's up close to about 6.5%. So that's also fueling the rally that we are seeing in Indian IT. But Gurmeet, thoughts on any of these mid-cap IT names? Anything that you like? Anything that you've bought in this year?
So I think this will be a year of differentiation. We saw a secular rally in 21 and probably at the early part of 2022, and then we saw. So I think there's too much negativity around IT, and that's how the results have been, marginally better in few cases. So we are following a basket approach. I think Persistent posted very good set of numbers. If you see, the IP business went up almost 8% QOQ. The services business was up 3-4%. Quarter on quarter, and this is despite the top client slightly degrowing. So similarly, I think we like some of these ERD names like KPIT Tech and Tata Elxsi now after seeing a sizable correction. We think this is more long term and a very niche play within IT. And my sense is that companies which are getting more, so you have to see the deal mix also. Any deals more on digital transformations, cost optimizations, I think the impact would be much less. Even if you see the Europe contribution in companies which have 25-30% from Europe was actually pretty good. It was North America which was slightly soft. So I think in run-up to the results, we probably saw too much negativity there and probably some catching up happening. But you got to be selective here. The valuations are fair, if not rich. They're definitely not cheap.
You know, look at the, Gurmeet, stay with us. Look at the rupee. Boy, that's a large move that we have on the currency. It's off the highs. The rupee is off the highs. I think it got to 80 point something in the morning. Right in the morning, it was appreciating against the dollar in a big way, and now it's going the other way. At least right now, some chatter that the RBI has been in the market. It was, of course, it looked like it was in the market on Thursday or something on last week, and we don't know. We don't have confirmation, but it's a pretty large 30 paise move coming through on the dollar rupee. It is 81.44. Well, we'll take a break. Gurmeet, of course, is still with us. We will also be joined by Sandeep Shah of Motilal Oswal Private Wealth Management on the other side for some more chat on markets. Stay with us.
Welcome back. Comfortably above 18,100. We're up 0.5% on the benchmark indices. Not yet at the day's high, but you can see the recovery that took place after the markets went to that low around 1:30 p.m. One of the stocks that we're tracking today is Bharti Airtel, and that's holding up firmly in the green. Morgan Stanley today has come out with a note, overweight on Bharti Airtel. Their target price is 860. Now, 860 was the 52-week high on Bharti Airtel, which was hit in November of last year. After that, from November to just the last couple of days, the stock had seen a correction of nearly 100 points. It went down to levels from 860 down to 750. Morgan believes there is a floor to the stock price at 725, and they believe any correction to levels of 725 should be a buying opportunity. One thing that I want to talk about, when we talk about telecom sectors, the big trigger is a tariff hike. Now, the street is worried that what if a tariff hike doesn't take place? Then we are going to see earnings downgrades or earnings estimates coming down. The tariff hike has not taken place now for 13 months. In an event that a tariff hike doesn't take place, Bharti Airtel is perhaps better placed than Reliance Jio, because Reliance Jio started off with 4G subscribers. And Bharti Airtel has a lot of 2G subscribers. So the pure migration of 2G subscribers to 4G subscribers will drive an ARPU tailwind, which, say, a Reliance Jio does not have. So that's one of the points of differentiation between Bharti Airtel and Reliance Jio, which is also why investors, like Bharti Airtel along with, Reliance Industries. And this is, of course, the only pure play telecom company per se.
It's very interesting you brought this up, Rima, because I actually had a question with Gurmeet exactly on this. When what Reliance's earnings told us on Friday is that telecom is doing really well, but where is the elusive tariff hike, right? And especially when capex is pretty high as you go ahead with your 5G rollouts. So Gurmeet, that question to you, you heard what the foreign brokerages are saying on Bharti. What is your preferred telecom play between the two? And a specific take on Bharti, if you believe that it can really take out the earlier highs of 840 plus.
So, Shilpi, good to see you back. So I think
talk to you again. Thank you.
Telecom seems to be in a sweet spot with almost, I call it 2.5 players with the way Vodafone is right now. If you see Bharti, they have done a market testing where they have withdrawn the 99 rupees back in Odisha and Haryana, and the minimum recharge there is 155 and that's like sending the message that they are keen on tariff hikes, and they did guide for 200 and later on 300 ARPU in next couple of years. So I think if that goes on well, I think the intent is clear. Also, if you see, as you rightly pointed out, as Eva pointed out, they're gaining in not only metros but also in Class A cities over Jio in terms of the 4G mix. So that continues to improve, which will strengthen their ARPU probably more than Jio, assuming there is some delay in tariff hike. Continues to do well in the home and enterprise segment. They've stated out plans of monetizing the payment banks. And it's the only profitable payment bank as far as India is concerned. Also, if you see their EBITDA versus payouts, I think for the first time in last year or so, they're making more than what they are paying. So they're making like 35,000 crores against annual payouts of 23,000 crores on AGR and Spectrum, which means there is a scope for deleveraging because they are at about almost 2 lakh crore debt. So I think I'm pretty constructive. Valuation is reasonable and then should do well in my view.
Okay, all right. So that's about Bharati Airtel. Then, Gurmeet, I want to ask you on the ferrous space. Well, let's just tell our viewers first that JSW Steel is down close to around 1%, despite the numbers being a little bit better than what the street was working with. So the consolidated number should come up for you both on the EBITDA and the margin front as well. It's a little better than our poll. A couple of factors played out. One is the standalone EBITDA per ton. Well, that improved. It close to have doubled on a sequential basis, and it was close to around 200 rupees ahead of our estimate of around 7,900 rupees. Bhushan Power and Steel, well, it delivered an EBITDA loss, which has turned it on. And also you have the European operations that looked quite good. Let's highlight what the brokerages are making. So the numbers are good, but brokerages on the whole, they believe that the stock is trading at expensive valuation. CLSA, they have a sell rating, target price of 640 rupees. They're expecting the profitability to improve. In fact, for next year, they're working with around 12,000 rupees per ton. Capacity expansion, they take on board, but the dependence on exports will be far more, and that is margin dilutive. They also say the stock at around 8 times EV per EBITDA, valuations remain expensive. Moving to Jefferies, they have an underperformed rating with a target price around 470 rupees. The stock trades at around 2.4 times price to book, and that's expensive for a stock that's giving an ROE of only around 10%. They have cut their EPS estimates by around 11 to around 13%, and keep in mind they're 50% lower than what the street is working with. ICICI Securities, well, they retain a sell rating. They say that JSW Steel is most vulnerable to the steel cycle because of the high debt that it has in its books, which amounts to around 70,000 crore rupees. Gurmeet, what's your sense on the ferrous space? You know, for the last couple of months, these ferrous stocks have done very, very well. But the street believes, particularly for JSW Steel, that it's too expensive. Will you go for another ferrous name?
Imagine we usually avoid ferrous steel stocks because they are more tactical. And as you made the point, you've got to be very nimble-footed in moving in and out. You made that point on 8 times on EV by EBITDA, and also at price to book is upwards of 2. Plus high debt, which can always be an issue in a rising interest rate environment. So my preferred pick would be Tata Steel. Let's say if I were to be tactical. One space we like, which is more a sub-segment of this, is the specialty and alloy steel. And there's one company which we just added to the portfolio, which is Mokal, where I think it's a more turnaround story with debt getting reduced by 15,000 crores. Bajaj Group ownership now almost 74%. Their turnover is now likely to be double at 6,000 crores. The results are due in February. So it's a reduction of interest cost of over 100 crores in a year. The top line is almost up 70-80%. Ownership management change. So there are multiple levers in place. In terms of that as a story. So we prefer that as something which is more durable and more long-term than over steel. We will be tactical in case there is some correction in some of the ferrous names, even some of the non-ferrous names. Open to look at it, but only tactical.
Okay, lots of names moving around in the broader market. By the way, advanced decline is negative. 1,200 stocks are lower and about 1,050 stocks are higher right now. Put up PI Industries if we can. Stocks down about 3.5%. It's a big liquid name and it's corrected a bit. A big outperformer, wealth creator over the years. So over a very longer term chart, I mean, this would seem like a bit of a blip, but it has started this year down again. It's down 8% for the year so far. And by the way, Gurmeet likes PI, if I remember correctly. Atul is selling off after Friday's sell-off. It was down sharply on Friday. It's down another 4%. Atul Limited. That should also come up. Shree Cements, I think we did mention the name earlier. It's down 5%. There is, what else? Dalmia Bharat, which is down 3.5%. A lot of cement, of course, is selling off. JSW Energy, we had the management with us earlier in the morning. It was down, started down 3%. It's down almost 6% now. So there is a lot of stuff which is selling off. There is Craftsman Auto, right? It's done very well. But down 3.5%. Again, results were not up to the mark, and stocks down about 3.5% in that sense. Reliance is the other one, right? I mean, it's down, and what's the worry? Is there a niggling worry? What a brokerage is saying? Sonia is here with the details. Sonia, over to you.
Well, thanks a lot for that. I do want to draw your attention to the key highlights from the Reliance Industries earnings. Now, the big takeaway really was that the O2C business was very strong, better than what the street was estimating. So EBITDA went up about 16% sequentially. The margins in the oil to chemicals business have improved to 10%. Now, what's happening with Reliance is that there is a huge capacity expansion plan, and in this quarter gone by, the capex surged by 16% quarter on quarter at over 37,600 crores. Now, this surge in capex is driven by a 5G rollout in 134 cities, as well as the aggressive expansion plans that the retail business has for Reliance Industries, where they're adding 6 million square feet over 789 new stores. Now, a lot of brokerages are bullish. JM Financial has reiterated a buy. They expect a robust 14 to 16% EPS compounded growth over the next 3 to 5 years. Nomura, Jefferies and JP Morgan all have either buys or overweights with target prices of anywhere between 2850 to about 3100. But the net debt has gone up by about 18% quarter on quarter because of this large capex plan that I was talking about on account of the 5G and the ramp up in the retail operations. So because of that, there could perhaps be stress on the balance sheet, and hence a lot of brokerages have, while maintaining their positive and their buy status, have also cut down their EPS estimates because of this aggressive expansion plan. So Nomura has cut FY23 EPS by 6%. CLSA has cut FY24 and 25 EPS by about 8%. Back to you.
Okay, high debt hurting in a rising interest rate environment. Sonia, thank you very much for that. Now, Reliance Industries stock price hasn't gone anywhere over the last 2 years. It's been extremely range bound. CLSA has highlighted a few triggers for the stock going ahead. One of them is going to be the fact that they're very aggressively focusing on the wireless broadband. They've been up until now focusing a lot on getting 4G wireless mobile customers. But now they're looking to ramp up their air fiber, which is their wireless business, the Wi-Fi at home. And that the ARPUs are typically higher over there. Secondly, possible launch of an affordable 5G smartphone. 3, further strides in their FMCG foray, and 4th, IPO of Jio and or retail in the next 12 to 18 months. So according to CLSA, while the stock has been range bound over the past 2 years, they believe this may change in the second half of this calendar year.
Thanks very much, Rima, for that. So that's Reliance for you. Gurmeet, thank you very much for your time. Great to have you with us here. Appreciate you joining in with that perspective. Thanks indeed. Sandeep Desai is with us, Managing Partner at Motilal Oswal Private Wealth Management. Sandeep, great to have you with us here as always. Appreciate your time. I just want a quick market view from you, Sandeep. Up or down, near term? What's your sense?
For now, sideways, of course. But I'm hoping that given the fact that global macros look far more conducive with the dollar index peaking out and US interest rates hopefully peaking out this quarter as well, and the fact that in spite of all the noises about deglobalization, world trade as a percentage of GDP is close to an all-time high, which means that countries are anxiously seeking alternatives to China, including India. Of course, domestically, there's a bit of a minor slowdown in growth in the second half, and but with margin pressures abating from next quarter, and if the budget doesn't have any major negative surprises, I think we may slowly grind higher. But there could be some volatility in the near term. And while valuations, of course, are not as cheap as they have been, but we are far cheaper than it was the last time we were at these levels in October 21. And if you were to look at forward earnings, we are at par on a P basis with long-term averages. And while price to book being a more robust indicator, while it's 15% higher than average, ROE is also at 10%. Premium. So if the ROE incline continues upwards, then you would continue to expect to see higher valuations. So I think you should buy into any weakness post-budget, while I would recommend staggering flows over the next 3 to 6 months. In case you see a significant correction post-budget or because of any other reason, I think you should actually go in 50% lump sum and spread the balance. But certainly not the time to get overweight on equities, but obviously the long-term outlook for India remains extremely robust. And there's an interesting point here that the last time the debt levels of the Nifty 500 companies were at these levels, that was in 2005, profits more than tripled over the next 5 years. And this was on the back of total assets also going up 5 times. So, corporate India has never been so significantly deleveraged. Credit growth is back. So I think one should hope that with capex coming back, we should actually growth while it's slowing down this second half. I think it should bounce back next year.
Okay, so keep some powder dry while you deploy some right away. Sandeep, good talking to you after the gap Surabhi here. Given what you just said, let me ask you, if you had 100 rupees, how would you split it between banks, where you're buying growth, and let's say IT, where you're looking for bargains?
So to begin with, I wouldn't put all my money between these two sectors, but I guess let's presume that there's an existing portfolio and there's incremental cash, right? So I would actually be inclined to go 2/3 of the incremental allocation into banks and only 1/3 in IT, because while banks, I think the credit growth remains very strong. Corporate India is deleveraged. You've got while you're seeing that there is some pressure on CASA for some of the banks, the more important point is credit quality, and credit quality remains pristine, and it's likely to remain good for the next couple of years at least. And valuations, while they're no longer cheap of private banks, they're not really expensive either. They're more in line with the long-term averages. So you may not have a significant case for a re-rating, but you've got a significant case for earnings growth driving stock prices of financials. On the other hand, IT, while the worst may be over in terms of margin pressure, while order books are growing, especially for the larger ones, for the mid-tier IT, it's actually been a little mixed bag. It's really dependent on which sectors the mid-tier IT is dependent on. Valuations, of course, are more reasonable now and more on your side. And I think the bigger theme that digitization is only going to gain momentum no matter what. And I think on that premise, I think one would like to buy IT, but IT is something that you would be nibbling away rather than going in for a full-blown out purchase.
Okay, all right. Hi, Sandeep. Good afternoon. Sandeep, you all have been a little bit cautious on the cement pack. That's playing out today. But what would make you all turn your stance? Today the street clearly is spooked by Ultratech's commentary on the pricing front. Some part of the street believes that this may be an overreaction. What would make you all turn your stance on this? Because after all, if India is going to grow, cement consumption is going to be, moving in pace or moving a little bit, growth is going to be a little bit better. So explain that to us.
I don't think there's any problem with the volume story or the demand story at all. As you rightly mentioned, with the real estate sector looking up, with hopefully infrastructure and the government spend on infrastructure, hopefully that picking up as well, you should see demand for cement. But really, it's a question of, at what price do you buy them, and what's the outlook for supply in the medium to longer term? While volume growth, may still be close to double digits, margin pressures continue. And while there may be some marginal sequential decline in margins, I think it's really a question of finding margin of safety in the sector, and B, in terms of the fact that that you're not just buying cement stocks in hopes that there'll be a cartel and there won't be any significant price cutting because of capacity coming up. The market starts pricing in capacity before it starts coming up, right? It's not like you wait for the cement capacity to come on stream and then you see the impact. The stock price is already trying to anticipate that. And, with some big players having entered this, the concerns remain that there could be significant capacity addition. Of course, the skeptics would argue that, it's in everybody's interest to maintain price and margin discipline. But, that's more of a hope. So, I would prefer to be invested in sectors and companies where there is margin of safety, where one doesn't have to hope that certain things play out, but one can actually see the data points supporting one's view.
Sandeep, I wanted to draw your attention to ICICI Bank. The stock is flat despite very strong numbers. And ICICI Bank has gotten re-rated over the last 3 years. Given the lukewarm reaction to what is a very strong quarter, do you think the market is already priced in, the best of the numbers, the re-rating is now behind ICICI Bank, and money could move out of ICICI Bank into other banks, maybe PSU or other private sector banks?
It would seem that, the leader of the banking pack for the last 2-3 years is obviously the re-rating. Bulk of it is over. And I think that incremental re-rating, if any, will be more gradual and dependent on, demonstrating that they can consistently maintain credit quality. One measure of credit quality is always gross NPAs, and that continues to remain higher than, say, the likes of HDFC Bank. And to some extent, we've also seen that banks like HDFC Bank, where the market was concerned perhaps on their technology interface and concerns over FI selling there, that seems to have abated. So I think we're probably already seeing a bit of that already underway. We've clearly seen that PSU banks have bounced back. But obviously, PSU banks, except for perhaps the largest, would primarily remain a tactical call. I mean, it's not a buy and hold. Whereas I think long-term investors can still buy, the leader of the banking pack even today, even if there isn't going to be significant re-rating, because earnings growth is still likely to remain quite strong. So yes, we've already seen the bulk of the re-rating, but depending upon how they demonstrate that their credit quality can be among the best in the banking sector, you could still see marginal scope. And of course, there's always a play of subsidiaries, value getting aggregated there as well.
All right, Sandeep, we'll leave it there. Thank you very much for your time. It's a pleasure, as always, having you with us here on the program. Rima, we were talking about this the company called Nureka, right?
Yeah, it is, yes. Yeah.
On Friday, it's up another 15%. On I think on Friday it was up on circuit. And today it's up another 15%. This is I was doubtful, but not anymore. This is Dr. Trust. I mean,
okay. But do you know why it's been moving up? What's driving this momentum?
Idea. That is now I'll have to do some work. But so it listed in 2021, February of 2021. At about 680 or so, went up all the way, I guess, during COVID because of the demand for these devices. I mean, they make all kinds of. I mean, they make
BP monitors,
everything.
Machines,
yeah. I mean, actually, pretty good products. I've used them as well.
Okay.
And it went up all the way from 680 to about 1800 in a couple of months, and from there it's just been a one-way down journey. And now it's making a bit of a comeback to about 460. Maybe we should invite the management. I think it's a Chandigarh-based company. We should invite the management for a chat at some point. We'll take a quick break here. As always, we'll get you the buy today, sell tomorrow calls with our technical experts on the other side. Stay with us. There is, 20 minutes to go for market closing.
Welcome back to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, the markets have done pretty well. At least we're holding on to that 100-point odd, gain, which is good news, actually. Though the breadth of the market is still lagging, you have way more number of stocks that are declining in comparison to the number of stocks that are advancing. So the crisscross lines will tell you the picture. When we started off trade, there were closer on 4 stocks that were advancing for 1 stock that was declining. Mitesh Thakkar is back with us. Mitesh, what do you make of the action today? Not too bad, one would say. But still, we'll require a bigger trigger to get us past this 18,200, 18,250 odd mark.
So that's right. I think that strength to break on the upside is still, missing. But I think with every passing day, given the fact that the daily indicators are now kind of bottoming out, trying to come out of the oversold levels, the possibility is slightly getting stronger. Actually, eventually, the actual price actually will dictate. And once we start getting past 18,180, 200, I think that should add momentum on the upside. Till then, trade with stock-specific biases. I have a Birla Software as a BTST call right now. That's one of the names on the IT space, which I've been recommending earlier as well. So this is a BTST with a stop at about 298, targets of 310 here. And the other is Eicher Motors. That's also closing very nicely with good hourly charts. So that's a BTST with a stop below 3185, another 3180 for targets of 3235.
Okay, thank you very much for that, Mitesh. Axis Bank will be reporting Q3 numbers later today. Abhishek stands in with the key expectations. Abhishek, should we also expect a strong performance from Axis considering its peers have all reported good numbers?
See, when you spoke about peers, Rima, you need to watch out for one key factor that's differentiating private banks' results. If you have deposit growth, you are rewarded by street. If you have only loan growth and net interest margin improvement, that's not being rewarded, point in case being ICICI Bank. So for Axis Bank, the key things to watch out is that the net interest margin will improve YOY and quarter-on-quarter. Sequentially, Phillip Capital is estimating a 9 basis point increase in the net interest margin. Now, Phillip Capital estimates loan growth to be around 15.5% YOY and about 5% sequentially. This is largely in line with what the industry level loan growth has been. The stress portfolio, the watch list at about 8,000 crore and the restructured book at about 3,000 crore, how that moves will be seen closely. Asset quality largely to improve given the fact that Phillip Capital is estimating 10 basis point decline in gross NPA ratio, and they are expecting slippages at about 3,500 crore versus a little under 3,400 crore in the previous quarter. Now, management commentary with respect to outlook going ahead in terms of deposit, loan growth, as well as the credit cost will be seen closely. Our polls suggest NII growth of 26.5% YOY and about 5.7% sequentially. We are working with a profit growth of 51.4% YOY and about 2.7% sequentially. Back to you.
Okay, Abhishek, got that. Thank you very much. In fact, let's take that point that Abhishek was making forward with Sudeep. Sudeep, good afternoon. Good to be chatting with you after a bit of a gap. Banks, really, that's the question, because let's face it, when you are talking about buying at multi-year highs, if not all-time highs, for a lot of these blue-chip names, do you have the comfort? The market, as Abhishek is saying, wants more, and not just happy with, let's say, improvement in asset quality or even margin expansion for that matter.
Good to see you back, Surabhi. Welcome back. Yes, I think the banking space is an interesting position now. There is absolutely no doubt probably in any analyst's mind that this financial year on the coming one is going to be good for the banks. And that's pretty much got played out and is still getting played out. Now, the only question, Surabhi, here is the valuation. We know the valuations have reached a level where the margin of error is very, very limited. We have seen the story getting played out as far as NIM is concerned, as far as loan growth is concerned, and as far as asset quality is concerned. So I think the market, as Abhishek was just mentioning, is rewarding the deposit growth, because I think that's going to be a key component for the future. How well you're able to manage the liabilities and move more and more into low-cost liabilities. Now, if a bank is successfully doing it, that's getting rewarded. Now, that's the story by and large, I would say, as far as the private sector banks are concerned. But I personally feel, and I've been advising my clients, that as far as PSU banking space is concerned, there is still opportunity for a bit of a re-rating in some of the PSU banks, particularly where they are quoting at a book value below 1 time of book. And at a valuation of below 1 time of book. And I think some of the banks are still there, and there can be an opportunity of valuation pickup as far as these PSU banks are concerned. So overall banking space positive, but one has to be cognizant of the valuation at which one is buying. If you are buying, let's say, an Axis Bank, today, tomorrow, day after the results, better be in there for a year plus, because earnings pickup will take you forward.
Sudeep, hi, coming back to you, the market is still there, 90 points, but there is a little bit of a 3 p.m. kind of effect in two names. If you can have, I think, first persistent systems up, at 3 p.m., 258 or so, stock was at about 45.30. It's at about 46.50. I mean, that's a clean, 120, 130 rupee move in the last 10 minutes or so, 20 minutes or so. And then there is Coforge as well. Coforge had a big, a bit of a disappointing day on Friday. It went up sharply, but ended it sold off 5% from the day's high on Friday. But it's making up today with another surge, which we are seeing on Coforge. Both, of course, had reported results recently. We'll come back to more tech in just a bit, but Maruti was the other one which will report numbers. It comes out by afternoon, but that is tomorrow. Sonia is here, though, with a quick key expectation. Sonia, over to you.
Well, thanks a lot for that. So, Maruti, the stock is up about 24% from the March 2022 lows of around 6,800 or so. It's expected to be a strong showing this time around. So, a revenue growth of 17% is what we're looking at, in excess of 27,300 crores. The EBITDA will go up about 71% on a year-on-year basis at 2,669 crores, while the margins will improve to about 9.7%. Now, here's what happened this quarter. The volumes went up about 8% year-on-year at 4.65 lakh units, and it was a good, favorable product mix as well as price hikes that will be driving the 17% revenue growth for Maruti. The margins as well, on the back of lower raw material costs and better operating leverage, are expected to improve 300 basis points year-on-year and 50 basis points quarter-on-quarter. Now, a lot of management commentary is awaited. Any clarity on the chip shortage issue is keenly watched out for, because the management last time we spoke had said that they have no idea when the chip shortage issue will normalize completely. Any clarity on further improvement in the SUV market share, because that's the space they're gunning for? Earlier, they had said that their overall market share stands tall at 42% and the non-SUV market share is beyond 65%. But the retail growth in the SUV segment has been very strong, with pending orders of over 363,000. So any optimistic commentary on that will be keenly watched. Steady set of numbers expected this quarter. Back to you.
Okay, thank you very much for that. Sudeep, is Maruti something that excites you? The company has a lot of plans in terms of SUVs to try and regain the lost market share. Would you look at the stock?
Well, Rima, I'll wait and watch. I think, as rightly pointed out by Sonia and you, I think SUV is one segment which is very critical for their future. They have lost their market share. Mahindra is significantly ahead of them. We'll have to see. I mean, they're talking about new models and a lot of orders and things like that, but I will wait and watch. I don't want to rush into buying Maruti based on the expectation of their market share gains. Also, overall, the entire automobile space, particularly four-wheeler space, I'll be a little cautious at this stage. I think we have a little bit of challenge with urban demand, which is coming out in the commentary of multiple sectors. And I'll be a little careful as far as the four-wheeler companies are concerned. If I have to play the auto space, I will rather go and start buying into the auto ancillary companies. Some of them are very well positioned with global linkages as well as strong India business. So I will look at auto ancillary, not the four-wheeler companies.
Okay, so they've got that. Thank you very much for being with us. Great chatting with you as always. Thanks for joining us towards the market close. We've got a couple of minutes left. We will take a quick break before that. Market's finding it a little tough to sort of push through, retaining gains, and there's a fair amount of defensive buying. Lever is the top gainer at this point in time. More on the action as we get set for close in just a moment. Welcome back. Counting down to the last couple of minutes, and the story of the day is that we are up, not really all guns blazing, but we managed to retain most of the gains and no sort of last-minute hiccups. And Prashant, one thing that really stands out for me is that whole move in IT, which we've been seeing on Wall Street for some time, some of that is very truly back here. Not saying for the same reasons, but I think IT has been the star sector of the day.
IT has been the star sector, Surabhi, and on the other side, cement has been the star loser, right? I mean, absolute, a skid across the cement names. But IT has come back strongly. I was just remembering that interview we had with S. Narayan of ICICI. This was towards the end of December. He had said, buy IT into this recession or whatever is coming. Even from that point, I mean, the IT index is up 12%. So it's a pretty good run we've had. And towards the close, the IT index is coming off a little bit, just a little bit, 1.7 higher. But as I said, on the other side, we had pain coming through in cement. On the Nifty, I mean, leaves more to be desired. We got to a high of 18,161, but we leave off at closer to 18,100 or so. Rima.
So taking stock of the individual movers in IT, it was Tech Mahindra, Infosys, TCS. All three of them clocked in gains of close to about 1.5%. HUL sold off sharply on Friday after the company increased the royalty to their parent company, the foreign entity. But today, HUL has rebounded and it's reclaimed about 2% of its losses from last Friday. UPL, Sun Pharma were some of the other gainers. Bajaj Auto was higher by close to about 1.5%, reports its numbers later this week. On the losing side, Ultratech Cement down 4.5%. The street didn't find where the realization growth is coming from. Steel stocks, JSW Steel, Tata Steel, subdued in trade. Reliance Industries concerns around rising debt. L&T down 0.6%. And there goes the bell.
I just want to mention Yes Bank as well in terms of newsmakers beyond earnings. With this whole update on the 81 bonds issue, that's sort of put pressure on the stock because things are, of course, hanging in balance. The bank is moving to the higher court to take the matter further, but 8% down on Yes Bank. That's perhaps worth keeping in mind as well.
Okay, well, we'll wrap it up. The closing bell has been rung, and it's a wrap on this edition of this closing bell. But don't go anywhere. Our Monday special, Wizards of the Street, comes up next. An interesting conversation as always. Stay tuned.